Good morning, everybody. My name is Carlos Gill. I'm the Chief Investment Officer of Microequities Asset Management, and today's webinar is on our Pure Microcap Value Fund glass quarter full. So just before we start the presentation, I like to engage with the audience. And what I'm going to be doing is I'm going to be pausing every couple of slides to take questions from the audience. And if you want to ask me a question on any of the subjects detailed in the slides, all you have to do is click on the Q&A and send me a question, and I'll endeavour to answer it. Like I said, I will stop every couple of slides to let the audience participate, and that will make for a much more interesting webinar. It'll be much more fluid and it'll be much more interesting. So without further ado, it's right on 11 a.m. and I'm going to begin the webinar. So just the obligatory legal disclaimer that we have to put through according to our legal advice. So on any talk that I give or any webinar that I provide, my first objective is always to educate investors and try to make the material as formative as possible. So at the end of the talk, at the end of the webinar, if you actually take some of the concepts and some of our investment tenets and actually put them into work, I think you can improve markedly the success and the investment outcomes that you have directly in your own share portfolio or in indirect equity portfolios with us or with other investment fund managers. And the first few slides of this webinar, if you've listened to any of my previous webinars, you'll be familiar with them. But I like to reiterate by repetition and make sure that these really ground level conceptual elements are properly discussed and displayed so investors that are new to our audience can actually understand. And these first few slides actually really form the conceptual framework of how the investment management team at Microequities actually allocates capital. They're incredibly important. I do want to press that this is how we think about companies. This is how we think about investing, and the time horizons that we're talking about and we'll be discussing throughout this webinar are conceptually laid out as to why we do that in these first few slides. They're actually really critical. And I think any investor that's not familiar with them, it may contradict your previous understanding of equities and shares. But I think if you take them on hold and you actually apply them, they'll put you in good stead to improve your long-term investment outcomes. So what is an equity investment? Technically, equity investments or shares, for the lack of a better term, is a residual claim on the remaining net assets of a company in the event it is wound up or liquidated. So, if a company decides that it's no longer wants to continue as a going concern, it can decide to liquidate all its assets, pay its liabilities, and if there's any residual net assets after that process has been undertaken, those net assets then get distributed to the equity holders, the shareholders. It also provides you, in the event that the business operates on a going concern and it's profitable, and it decides to distribute all or a portion of its retained earnings by a distribution, otherwise known as a dividend, it provides you a pro rata proportional claim on any distribution of those profits. Under the Corporations Law of Australia, it also affords you a range of voting rights on certain prescribed matters. So that's what equity and shares is from a technical legal perspective. But really, what is it conceptually? Well, the way that we think about equity investments or shares is that we fundamentally are business partners. We kind of think whether we buy 1% of a company or 20% of a company, we think of entering into that transaction, entering into that relationship as tantamount to entering into a business partnership. That is the ultimate investment outcome of that economic relationship will be driven by the economic success of the business enterprise over the long term. And so if I decide to buy shares of the ANZ Bank, I'm becoming a de facto business partner in the economic venture of the ANZ Banking Corporation. And ultimately, over the course of my business partnership relationship, the investment outcome that I derive from that relationship will be driven by the economic success or lack thereof of the ANZ Banking Corporation. And what that means, if you really embrace that conceptually, if you think about buying shares as entering into a business partnership, doesn't matter that you might own 1% or that you're a silent business partner, but the key element is you're entering into a business relationship. And if you really embrace that conceptually, it really takes you on a pathway of long-term investing. I'm sure there's plenty of people in the audience that have businesses themselves or are business partners of private enterprise, of private companies. And I'm sure the first time you envisage entering into that relationship, you wouldn't think of it as a 6-month or 12-month relationship. If somebody puts forward a potential investment in a private company and you want to enter it, and they propose that you enter into a business partnership, you don't think of that relationship in terms of time frameworks of a 6 or 12-month, 18-month time. You really think about, geez, I'm going to be a business partner. What's this business going to look like in 5, 6, 7, 8 years from now? And so the investment management team thinks exactly the same way. Now, we may not stay invested for 10 years. Sometimes events occur where we might be invested for only 4 years, 3 years. The company may be bought out. There's a whole set of circumstances that may or may not affect the range of the time horizon of our investment. But certainly the intent at original time of capital deployment is to be co-invested as constructive business partners for a minimum of 5 years. And in fact, today, there are companies that we own in our Deep Value Fund, which has been running for over 14 years, that we own from day one. So, we've got a 14-year plus business partnership in some of those investments. So that's really critical, and it's important to understand that. There's already a few questions, so let me see if okay, no, it's regarding the audio. I'll bring the mic closer to me, so hopefully that improves the audio. Okay, second critical slide, and a lot of investors kind of interlink market prices to value. So what's the difference between market price and intrinsic value or value? Market price is simply what current buyers and sellers are prepared to trade parcels of a business at. And when I'm talking about market price, I'm specifically talking about share prices. So that's just what current buyers and sellers are currently prepared to trade the business at. And that can be influenced over the short term by many things. It can be influenced by liquidity profiles of the existing shareholders. It can be driven by sentiment. It can be driven by fads, fashion, short-term sentiment, a whole range of factors. So market price is easily identifiable. You can observe it. You don't need a finance degree. You don't need to understand. You don't need to do any deep mathematical calculations. You can arrive at the market price. It's easily observable by the market prices that are trading in the stock exchange. Intrinsic value is different, and very often it's completely unrelated to the prevailing market price. Intrinsic value technically is derived from the computation of future cash flows of an investment adjusted for time and risk, the time value and risk. So if you've got, for example, a treasury bond, government bond, it's got a certain yield, it's got a certain maturation date. To work out the value of that bond, you can derive it through a simple mathematical computation on the future forecasted yield and discount it for time and risk. In terms of equity investments, which is what we do, We only invest in profitable businesses, and these businesses therefore generate cash flows. And we typically look to invest in businesses that are going to be increasing their future cash flows over the long term. So we make a series of projections and assumptions as to what the future cash flow generation profile of a business will look like. We then bring those projections of future cash flow to today's value. So we discount for time, and then we risk adjust them on the basis of the fundamental risk of each of our investments. So an intrinsic value is a computation. It's a mathematical computation based on the future cash flows of a financial asset. And that's an important distinction because there are assets that are not necessarily financial assets. So you can buy gold, and gold doesn't yield, can't derive at the intrinsic value of gold through making a future projection on its cash flows. Gold will be driven by whatever buyers and sellers want to price that asset at. You can buy Bitcoin, it's the same thing. You can buy a painting from a renowned artist, and it's not really going to generate any cash flow in simplistic terms. So you don't derive it through, it's not a financial asset. It's an asset, but it's not a financial asset. And we focus on financial assets, in this case, small and microcap industrial companies that are generating profit and are generating future cash flows where we can derive at an intrinsic valuation. And we're value investors. So that means that we're trying to identify assets whose intrinsic value is materially higher than the prevailing market price. And that's where we gain an edge, a competitive advantage, by identifying assets that are mispriced. And the stock market in itself is inefficient. And it's particularly inefficient in the small cap and the micro cap side of the market, where there is more information asymmetry. There's less professional investors that are competing against each other in order to create what we call price discovery, in order to price these assets but on the basis of their intrinsic valuations. So that means there are inherent pockets of significant market inefficiency where we can deploy capital in assets that we've derived their intrinsic value to be materially higher than the current market price, and that affords us an additional risk buffer. It's also important to kind of distinguish the differences between what risk is. The majority of investors will take risk as the chance that the market price of an asset falls. That is not our definition of risk, although that is the viewpoint of the financial academia. So if you've done finance and you've done a degree in finance, they will teach you that market price volatility is equal to risk. Now, market price is relevant, and if you're only investing for the course of 6 or 12 months and you're going to liquidate an asset, you will be much more price sensitive to what the current market price is, because your investment outcome will be determined by what you can sell the asset by. If you're investing with a viewpoint of 5 to 10 years, the short-term volatility over the course of the next 2 or 3 years is irrelevant to you, because you're not looking to liquidate that asset over that time. What matters to you is whether fundamentally the business, the equity investment you're undertaking, you're entering into that business partnership, is going to grow. And that will be the key determinant, the key driver over the course of 10 years, 8 years. Anything that's long-term, that will be the key determinant of your investment outcome. And hence, for us, it's not about market price volatility. We look at it as if we owned the entirety of the business. And if you own a business yourselves, you're inherently concerned not with what my business might sell tomorrow, but what are the drivers? What are the fundamental drivers? How many clients do I have? How much revenue? How diversified my client base is? What are my operational margins? What's my cash flow? What's my growth going to look like over the next few years? These are all fundamental factors that concern you as a business owner. And so we think exactly the same way. We're not concerned if we buy into a business today and 6 months from now without any fundamental adverse event, the share price has fallen by 20 or 30%. That is not a risk event for us because fundamentally there's been no change to the intrinsic value. And so we're focusing on the intrinsic value, and the intrinsic value to us is our Northern Star, that we assess the business through the fundamental value. We don't assess the health of a business through its market price, which we consider to be a false guide. It really is about assessing the business as if you owned it, and based on the fundamental drivers of intrinsic valuations that do affect the computation of cash flows. That's really, really important. And these two slides are really what lays the foundation for our investment tenets and the way we think about deploying capital. So I'm just going to pause to see if there's any further questions. No, so no questions so far. So just as a reminder, if you want to ask a question on any of the slides, please click the Q&A icon and type your question and I'll endeavour to answer it. So I like to put this chart because it provides a little bit of context on the historical returns of the ASX. There's actually 124 years of history here. And what this slide does is it gives you a visual representation of the historical return profile of the Australian stock market. And probably just a few conclusions. You will see that there is a lot more greens than reds. So the ASX has historically delivered a lot more positive years than negative years. It actually runs at about 20%. The reds are about at 20% and the greens are at about 80%. So the key conclusions out of this is if you think about investing over the long term, the chances are your investment will appreciate over time because most years, 80% of the time, in fact, the ASX market rises. In the context of a 10-year investment, you should also assume that you're going to have negative market-based return years. So sometimes I've received emails when some of our funds have provided single-digit base returns, and I may get an email from an investor and they'll say, Carlos, you had a bit of a rough year. You only delivered 5 or 4% return. To which I always reply, no, a rough year in terms of equity returns is a year that starts with a negative. And by the way, you should expect to have negative base market returns because that's to expect otherwise is not a realistic assumption. You will have negative base returns. But what long-term investment does is nobody knows what the next couple of years will provide. We don't know whether this year, 2024, will end up in the green or black. We can say statistically there's an 80% chance it'll be green, but we don't know. We could have a negative base return and we don't have a crystal ball and we don't profess to know market directions. But what we do know is this is a lottery in terms of the market timing, and we don't buy lottery tickets in terms of playing the roulette as to whether this year is going to be a negative year or a positive year. The way to reduce the roulette table of market timing is to actually invest over the long term, because you can see that there's never been a protracted period where there's been a lot of negative returns. So the longer that you're investing in equities, the more you remove the chances of a negative outcome. And that is actually visually represented in this next slide. So this is based on the Standard & Poor's 500 returns. But if we actually if we actually applied the ASX data, this would look quite similar. And what this chart provides is the range of investment outcomes if you've only got a 12-month investment term. And what you can see here is that You're more likely to get a positive return than negative, only just. And the range is actually really broad. The widest loss you could have historically is a -43, and the best you could have historically, if you only invested for 12 months, is a 54% return. And you could end up anywhere between that if you only invested for 12 months. If you invested for 3 years, what you see is the negative range starts to curtail, and so does the positive range. But as you're invested longer and longer periods, the probability of you attaining a negative base return becomes very, very low until it dissipates all the way in 20-year periods. You've actually got all positive ranges. So the way to reduce market timing, the market timing roulette, is to actually be invested over the long term. And when you think about that first slide about equating equity investments to a business partnership, it actually links to that very well as well, because you are investing in business partnerships, and the investment outcomes, in order for the investment outcomes of the enterprise to drive your investment return, you have to be invested over the long period. But you get an added benefit in that we don't know what the market will do this year or the next year. That's a roulette table that we don't play at. But the longer you're invested in the market, the lower the probability that you will actually derive a negative outcome, irrespective of how well your fund does or your portfolio of equities. I've got a question from Ryan, who asks, when you talk about fundamental value, do you use DCF or reverse DCF, or does it depend on the business? Ryan, we typically use a DCF. We build 10-year discount cash flow models. And for those that are not familiar with what a DCF is, it's just a mathematical model that projects what the free cash flow of a business will be in year 1, year 2, year 3, year 4, and then applies also a terminal value to the business. It brings it back to today's value and then applies a risk premium to it to take into account the specific risks of the business. In some situations, Ryan, we won't even build a DCF. Sometimes we come across a business that is so overtly cheap that we don't need to build a DCF to tell us that the fundamental value of the business is 100% plus over the current market price. There are sometimes investment opportunities available to us in our asset class that are so obvious that we might be buying a business. I'll give you a case, actually a tangible example. One of the newest additions that we've bought in our Pure Microcap Value Fund, and I'm not going to mention the name because we're still actively buying, but it's a financial services business. We've bought it at a price where the net tangible assets, which are, by the way, all cash, is above the current market price. And the earnings multiple that we've bought the business at is about 3 times its annualized profit. So if the business didn't grow but just maintained its current level of profitability, in 3 years, it would have generated earnings that equate to the current market price of the business, notwithstanding the fact that the current market price of the business is below the cash net tangible assets of the business, and the business doesn't have any debt. So our investment management team doesn't need to build a discount cash flow to let us know that business will, the fair value is significantly above, 100% of the current market price. We know we're buying a deeply discounted asset, completely mispriced by the market. Robert has got a question on this chart. Robert's asking whether these returns are total. No, they're only for the applicable period. So for example, the 3-year bar chart refers to the annualized, the range of annualized returns over a 3-year period. And a 5-year, for example, would be the range of compound annual returns over that 5-year period. It's a range. It means that the distribution the historical distribution of the return profile would be anywhere between -12.5 and 28.6. Okay, so I've completed kind of the formative conceptual foundation as to how we think about investing and how we think about companies. I'm going to spend the next few slides just talking about Microequities, the investment management team, and the profile of our investment management company. So the investment management team is made up of 6 members. The senior members of the investment management team have essentially been here from day one. We've actually never had any churn within our investment management team. We're specialists in small cap and microcap industrial businesses. We don't have anybody that has a geology background. So when I say industrial, I mean products and services, any business that sells a product and services. We therefore don't invest in mining and resources, not because we have something against mining and resources. We just don't have a geological expertise, and therefore we think other investors out there, professional investors, can do a better job at allocating capital in those type of businesses, and we would be at a disadvantage. So we don't want to compete with people that have a specialist skill set in mining and resources. But in terms of products and services, we can invest in a whole range of different industrial companies, ranging from retail businesses, professional services business, information and technology businesses, including consulting IT, managed services IT, software as a service IT. Historically, we've built our portfolios with a significant core technology set of investments. And today, if you look at the deep value, our Pure Microcap Fund, our global value microcap fund, there'd be a significant component of the portfolio dedicated to investing in technology. And we've been at the forefront of technology investing for a long time. In terms of the company was established in 2005. We launched our flagship deep value fund, and it was called the Deep Value Microcap Fund in 2009. We were one of the pioneers of institutionalized microcap investing in Australia, and we've been heavily supporting the asset class ever since. Personally, I've been investing in Australian industrial microcap since I was 16, so over 30 years of investment experience in this asset class. And on the subject of investing and co-investing, Microequities today manages over $600 million. The biggest client cohort, or the biggest client segment that we have, are the principals themselves, the board of directors, the investment management team, staff, and the actual balance sheet of Microequities. We are the biggest client. We have over $80 million co-invested alongside our clients. We don't get any discounts. We pay full fees like everybody else. There's no special treatment. It's 100% at arm's length. And that's not just all money that's been compounding over time. My chairman put in a significant new investment into the Pure Microcap Fund last month. I'm personally topping up in the Pure Microcap Fund this month. So we put fresh, new additional capital alongside our clients. But sometimes I smirk when I hear fund managers that say they've got skin in the game, and when you actually ask them how much of the funds under management they represent, it's less than 1%. Whereas I can look at our clients in the eye and say we're the biggest clients of our business. And what that means is we've put our personal and our family's money co-invested alongside our clients, and it means that we're paid to deliver returns, but our returns have to be risk weighted, and there is significant personal downside to for us as the largest co-investor in the funds themselves. There is consequences if investments go wrong. And so being the largest investor, it makes you acutely aware of not only the potential return, but what is my risk exposure in order to attain that return, that forecast return. Because ultimately, when you distill what the investment process is down to its molecular level, really, it's a very simplistic equation. You're trying to buy a positive investment outcome. You're trying to buy a positive return. And the price or the currency that you're paying in order to try and attain that return is called risk. And so the interrelationship between risk and return is critical if you're going to have a sustainable return profile. So this chart explains an interesting phenomenon that's arisen over the last 3 years. And if you've been reading economic and financial news, you've probably seen that there's been recent headlines of the small lords touching the historical all-time high, and the Nasdaq and the Standard & Poor's touching all-time highs. That is not unusual. That's what's meant to happen. If I go back to that chart of 124 years of historical data, over the long term, markets reach new heights and they breach previously historical highs. That is normal. That's what occurs. It's the same as if you chart a property index in Australia, there'll be new highs over time, and that's perfectly normal. It's an appreciating asset class, so that's not unusual. What's unusual is that typically the Small Ords Industrial Index had a very strong correlation to the All Ords Index. And you can see in this chart that the All Ords Index is reaching new highs. But the Small Ords Industrial Index actually is far away from its high. It actually peaked in the early part of 2021, and it's actually well below the peak. And that's an interesting phenomenon that we haven't observed for a significant period of time. And what this chart does, it actually brings it to a similar base unit of 1. So you can actually see that there was a divergence that emerged. And typically, historically, if you look at the All Ords and the Small Ords Industrial Index, there's a very strong correlation, and they move in unison. However, at the beginning of 2022, they started to form a significant divergence. And in fact, that divergence peaked late last year in 2023. We've seen it in recent months starting to close somewhat, but there's still a very large divergence. We can speculate as to what the reasons for that divergence might be, but it would only be speculating. It is difficult to distill the causality, and there's probably various elements that have given rise to that anomaly. But normally you don't see this type of dissonance, and particularly for such a prolonged period. And what that has provided is an opportunity set before us that is as good as I've ever seen in 30 years plus of investment, with the exception of the 2 systemic shock events that I've seen in the last 30 years of my investment career, which is the GFC and in the advent of COVID in 2020. Now, those 2 events, those systemic shock events, did create massive price anomalies. And there were massive price shocks where there was massive opportunity, but there were systemic shock events. The pricing opportunity that we're seeing right now is not due to a systemic shock event like the GFC or the advent of COVID, which emerged in February 2020. And actually, it didn't last that long. And by the end of 2020, that pricing gap had shut very quickly. This is actually a very different market, and it's one where right now it is highly fertile in terms of investment opportunity. We normally don't have the breadth and depth of investment opportunity. So what does this mean in terms of the recent historical profile of returns? So this chart here, which is a bit of a complex chart, I'm going to kind of unbundle it a little bit, is the gold bar here is our compound annual return performance for the Pure Fund. The grey bar here is the Emerging Companies Accumulation Index on a per annum basis, which is our benchmark for the Pure Microcap Value Fund. And this green chart here is a cumulative. So these first two are compound annual numbers, but this green one is a cumulative. It's the value added. So the difference between that and this figure here is the value added, and that's the cumulative value added over the 2-year period. This is the cumulative value period over the 3-year period. So you just reverting back to this slide, you can see that even though there's been a bear market in our benchmark over the last 3 years, we've still been able to deliver compound annual return of 12.4% against the benchmark, and that's an absolute number of performance, and it's also significant relative outperformance. Got a question from Peter. So I've just paused for more questions. I've got a question from Peter. He asks, how long do we hold a company in terms of your equity investment if the market value continues to be significantly less than the fundamental value? There's no time limit, Peter. I can tell you, for example, and I like to provide specific examples. We bought a financial technology software company by the name of GBST. I think we started investing in that business, if my memory serves me right, in 2018. GBST at the time had gone, I think, from being a market darling, valued at over $600 or $700 million. Share price, I think, went as high as $6. And then it fell back to about $240 or $250. And then we began to buy it. And 12 months into our first buying, the share price continued to fall. And it went as low as $1.20. And we bought more for the next 12 months. It really didn't do anything. Share price started to pick up a little bit. Company operationally began to get traction. They began to contain cost, deliver revenue growth. So fundamentally, the business was traveling well. And whilst the share price recovered slightly, it was still far off the intrinsic value. Eventually, a competitor decided to put forward, a much larger competitor, a NASDAQ-based competitor by the name of SS&C, decided to put forward a bid for the company. Then a UK private competitor put in a counter bid. There was a bidding war, and the share price ended up going for much, much higher price, and we ended up doing extremely well out of that return. We've got no time limit, Peter. We're long-term investors, and remember, our true North Star is the fundamental value. So when we're assessing how well our investments are tracking, we're assessing them from a fundamental perspective. So when we get the financial results at the end of the financial year, which is typically August, that's when they publish the financial results. We're assessing the intrinsic valuation growth of those companies in terms of revenue, profitability, margins, free cash flow. And that's our true north. And so long as the business continues to meet the investment thesis from an intrinsic value perspective, from a fundamental perspective, we're very happy business partners. So imagine you own your business and you own 100% of your business. You decide to list on the ASX. You decide to only sell 30% of the company to the public. You still retain 70%. You list the business is growing, but for whatever reason, the share market doesn't give you a fair price. The share price falls since you listed and 2 years down the track, you've grown the profitability, but the share price is still below. Are you concerned as an owner of that business? I would argue you should have no concerns because the intrinsic value has risen. And whilst the market may be inefficient over the short to medium term, it is quite Darwinian over the long term. If the share price stays highly depressed over very long periods of time, when I say long periods of time, Peter, I mean a year or 2 years, I mean 3-4 years, eventually somebody else comes in, either an industrial competitor or an industrial competitor backed by private equity will come in and transact and offer a closer to fair value price. So that's what happens, and we don't invest in businesses with a thesis that they'll be taken over, but eventually either the market revalues the asset properly or closer to the intrinsic valuation, or if its share price is depressed for prolonged periods of time, the company is vulnerable to friendly or hostile takeover activity. And we know that the market may be inefficient over the short to medium term, but over the long term, it does approximate closer to fair value. So that's why we don't concern ourselves with a market price. We're always concerned ourselves with the fundamentals of a business. You know, we never call up management of a team of a company and say, we're really concerned about your share price, you should do something about it. We call up management and we say, you know, we concern ourselves with the fundamentals. You know, why did your revenue fall by 8% this financial year? What's the causality of that? Why is your operational cost gone up by 10%? Those are the matters that concern us as business partners, as long-term equity holders, because we know ultimately those are the drivers of our investment outcomes. That's what's going to drive our investment returns. And this is probably the genesis of the title of this webinar. The glass is quarter full. So what we want to articulate at the moment on this slide is the opportunity set before us in the Pure Microcap Value Fund. And I'm going to talk about both of these charts. The top 4 investee companies, which, by the way, they're the top 4 investee companies because we risk weigh all our assets. The biggest holding in the Pure Microcap Fund, as would be the same in our Deep Value Fund, not necessarily where we're going to get the fastest rate of growth in terms of the revenue and the earnings, but it's where we think we're going to get the fastest rate of profit increase on a per unit of risk. So it's the highest quality asset that we have in terms of return and per unit of risk profile. At the moment, our 4 top investee companies, which account for 43% of the net assets of the Pure Microcap Value Fund, will, in all likelihood, double their earnings, double their profitability and free cash flow over the next 3 years. That is extremely strong earnings growth. That's not to say there are investee companies within this 58% segment that will grow their earnings at a slower or faster pace. There will be some businesses there that will grow at faster rates. All we're calling out is our top 4 holdings, which make up currently 43% of the NTA. Those 4 businesses are going to double their earnings within the next 3 years. And that for us will underpin the fundamental investment return profile of this fund. Additionally, we've done a deep dive in terms of the valuation metrics within the existing fund. We have 67% of the assets sitting in companies where we deem the intrinsic value to be at least 50% higher than the current market price, and in many cases, significantly above 50%, in many cases, over 100%. Those assets we would call out as being deeply undervalued and vulnerable to merger and acquisition activity. Then we've got a subset of growing and undervalued assets where they're undervalued by less than 50%. And then we've got a set of assets, 16% of the fund's assets are in businesses that the market is either at fair value or slightly above the fair value. And you might ask yourself, why do we still retain our investment in those companies? Is even though they might be priced at fair value currently, there is still significant earnings growth over the medium to long term that will drive the investment returns of those investee companies, and hence it still warrants us owning those assets. So 83% of the assets sitting in the Pure Microcap Value Fund are undervalued, and 67% of them are deeply undervalued and therefore vulnerable to M&A. That's why we're saying the glass in our Pure Microcap Value Fund is only a quarter full. And 43% of the assets, our top four, representing our top four investments, will double their earnings. And so you get a notion of the publicly listed space. A company that grows their earnings at 12, 14, 15% per annum is considered to be a very healthy growth profile on the ASX. If you look at most ASX 200 companies, you will typically have less than 10% revenue growth and earnings per share growth. If you look at the top four banks, historically, what they grow their earnings per share at, it's typically been below 10%. So a business that's going to double their earnings over the next 3 years, is considered exceptionally high growth. The two fundamental reasons why we invest in we only invest in small and microcap companies is, one, we have better long-term growth profiles, which, coming back to the initial slides, what's going to drive our investment outcomes as business partners, the economic fortunes of the enterprises that we've invested in, i.e. their revenue and profitability. And that might not drive the next 12 months worth of investment returns, because that will be driven by short-term market price movements. But I guarantee you, over the next 5 or 6 years, it's only the fundamentals that will determine the investment outcomes. It will be exclusively the fundamentals. So we invest in growth assets, and then we apply a very strict value doctrine to investing in those growth assets. And in the financial media, value and growth are often discussed as antithetical qualities. They're opposed. They are not opposed. If you are a professional investor, and if you're an equities professional investor and you are investing in growth assets, you better have an idea between the difference between value and price, because they're not always equal. And so what we do is we invest in growth assets, businesses where we judge and we assess the business to materially grow their earnings and profitability in the context of a 5+ year investment. And only deploy capital in businesses whose valuation, intrinsic valuation, we have derived is significantly above the current market price. When I say significantly above, I'm saying at least 50% at the time of original purchase. Got a question from Steve, who's asking, to what degree have you assessed the doubling growth is immune to recessionary conditions to actually play out? It's a great question, Steve. There's fundamental risk in every single investment we undertake. There is no asset that you can buy without any risk. So there's degrees of risk. And when we're doing a discount cash flow valuation, we're intrinsically assessing the risk. And we will look at things as, what is the quality of the business model? For example, one of the businesses we're investing in is a software as a service business, and their software is mission critical, i.e. it's not a nice to have technology software, it's a must have technology software, i.e. it is critical to the enterprise, to the mission enterprise of the business. So if they were to stop subscribing to this software, the business would not be able to operate or function. So the only risk is churn. And this type of software is incredibly hard to pull out. It's incredibly sticky. So this business, therefore, has what we call a retention rate, a dollar retention rate above 100%. What that means is that when these software contracts typically come up for renewal, when they actually renew, they renew for a dollar value that's greater than what it was previously. So this gives us very significant visibility in the retention and the security of that revenue profile. When we experienced COVID, for example, this business navigated through that treacherous operating environment with outstanding profit growth. And that's because, again, it was mission critical. You know, their end clients needed their software to function in an operating way. Not all businesses have a level of visibility or a security around the revenue stream as good as that business. And that's why we risk profile all the businesses. It's important to also highlight that not every investment we undertake is successful. We will make investments, and we have made investments where we make losses. And we will make future investments that we will make losses. Now, the reality is we have a portfolio of 41 industrial businesses, and we will more than offset any losses from one company or three companies with the rest of the profitable investments we make. At the end of the day, it's a mathematical addition and minus game. We know that what we are doing systematically brings the odds in our favor. It gives us an edge. And I'll explain in a later slide how we manage risk, because risk is at the forefront of successful investing. It's not about just trying to capture returns. It's what sort of risk are you exposing yourself in order to capture that return. That is the essence of investment and sustainable, successful investment. I mentioned before that I think it was a question that I got asked earlier about, you know, what happens when we buy a company and the share price stays depressed for long periods of time? And I said earlier that doesn't really concern us, because eventually there's, you know, takeover activity. And in recent years, particularly over the last 36 months, 90% of our exits, not only in our Pure Microcap Fund, but also our Deep Value Fund and our Global, our High Income Fund, are all coming from merger and acquisition activity. And we are seeing increasing merger and acquisition activity. Historically, we've always had merger and acquisition activity, but the intensity and the number of merger and acquisition events has certainly increased over the last 36 months. So this is a company that we invested in, led by Mark Bayliss, A2B. Mark Bayliss was parachuted in as CEO, I think, about 3 years ago. The previous CEO had a very different strategy. Mark Bayliss came in, essentially went back to core mission, to what A2B does best. His team also automated and put forward a lot of technology improvements that facilitated a cost reduction program that brought about significant improvement in the underlying unit economics of the business. The business had excess property. They sold the property, paid down debt, returned large dividend to shareholders. And then the company was subsequently subject to a friendly deal by an Indonesian transport group at a significant premium to the market price. We did extremely well out of this investment, and it's been one of our most recent takeover events. We actually have had to sell this business. The scheme of arrangement is actually still live, and we've actually sold out of A2B before the closure of that scheme of arrangement, because we needed that capital to redeploy it within other opportunities in our existing portfolio. Now, if we had held our investment in A2B until the completion of that scheme of arrangement, it would have provided us essentially a guaranteed internal rate of return equivalent to a 14% per annum return. We decided to waive that return because there were other opportunities inside the portfolio which had much better internal rate of return metrics. It tells you that, you know, we're willing to divest out of an investment where we had a guaranteed 14% IRR, and we said, and we took that cash and redeployed it. And it speaks to the opportunity set that I called out earlier that we presently have in our fund. Business that we invested, I think we invested in this business over 4 years ago. Cirrus Networks is a managed services business based in Perth. We invested in this business, I think it would have been in 2020. The business changed its CEO, took a structural review of the business, started improving the operational cost structure, started winning new clients, but the price of the business was still materially undervalued to what we considered to be the intrinsic value. And it was undervalued for the entirety of the time that we were investors in the business. Earlier this year, another IT services company that's actually listed on the stock exchange, Atura, came forward. My memory serves me right, with a initial premium to the market to the last traded price of 42%. At the time, Microequities Asset Management was the largest single shareholder in Cirrus. I think we had about 12% of the equity. We then engaged with Atura in very friendly conversations. We informed Atura that we would not sell at that price. We understood the industrial logic of Atura buying Cirrus, but we weren't prepared to sell at that price. Atura, to their credit, came by and improved their bid to 6.3%, which represented a 54% takeover premium. And by that time, we owned circa 15% of the equity, and we decided to sell to Atura and ended up with a very good investment outcome. Very recently, a business by a software as a service business by the name of Ansarada, which is a software provider of merger and acquisition data rooms. It's actually a world leader in merger and acquisitions data rooms, which is a very specific end use software as a service platform. We had followed that business since it was private. We followed it after the IPO. We didn't invest in the business when it IPO'd, given it hadn't met a profitability criterion. And I should state that all the businesses that we invest in our listed strategies must meet a profitability criteria. We simply will not invest in businesses that are generating losses. So we continue to track the business, watch the business grow, improved its cash burn. In the past 2 years, equity markets shifted their sentiment towards loss-making businesses. They began to demand profitability from companies. Management then decided to rein in the cost. They decided to turn the business profitable and generate cash flow positive. By that time, the share price had come off markedly from I think it was a $2.60 price. It had fallen to $1.20. So if you think about kind of the fundamental journey of the business, market price goes to $2.50, was loss-making, much lower intrinsic value for us. Share price then falls to $1.20, but by that time, revenue had grown, the business was positive, was trading profitably, and from an intrinsic valuation, had a bigger valuation. So all of a sudden, a gap appeared between the intrinsic valuation and the market price. We decided to deploy capital in our Pure Microcap Fund, and the company had a very solid balance sheet. It had $25 million of net cash, didn't have any financial debt. We bought it in 2023, paying $1.20 or a market capitalization of $107 million. You take away $25 million of cash, you're paying $82 million enterprise value. And this year in FY24, we expected the business to deliver $55 million of revenue and circa $20 million of operating profit. In February 2024, DataSite announced a takeover at $2.50. That represented more than double the entry price of Microequities. Again, I want to reiterate, we didn't buy Ansarada with a view that we thought it was likely to be taken over. That wasn't our thesis. It never is our thesis. We bought it because it was an undervalued asset. We understood the intrinsic value very well. We understood the technology. We understood where the product sat in terms of the market leadership position. We had met the management team various times through its public life. So we knew and understood the business and the unit economics of the business model well. And then we made a decision based on the intrinsic value, the market price, the fundamentals, and the risk of the intrinsic risk in the business. So I've got a question as well around what is the process that you use to determine risk as we have defined it. So risk, that's a question from Matthew. Matthew, risk, how we define it, is anything that can adversely affect the ability of a business to generate revenue, profit, and margin, right? And if you think about any business, like let's say you take Qantas, for example, right? What can affect Qantas from a fundamental risk perspective? If we were assessing to buy Qantas now, for the sake of transparency, we don't own Qantas, we've never owned Qantas, but let's say you asked us to assess the fundamental risk of Qantas. Well, the big risks in Qantas are, first, competitive behaviour. The Australian domestic air market is essentially a duopoly. If its biggest competitor decided to behave in an irrational manner from a pricing strategy and decided to go into a price battle, Qantas, in order to hold its significant market leadership share, would likely enter into that price war, and therefore margins in the most profitable segment of its operations would therefore decline. Then you've got a whole set of input risks around wages, aviation fuel. You've got aviation demand, both consumer and business. The demand for air travel is subject to a whole set of different variables and inputs that can change. You then have a regulatory framework, both domestically and international, in terms of federal government policy around how much competition the federal government decides to have in domestic aviation and international. You've got a whole set of operational risks events that could adversely affect Qantas. So if we were assessing the fundamental risks of Qantas, we would compute in our discount cash flow as a highly elevated risk profile. And consequently, the future cash flows that we would be forecasting for Qantas would be highly discounted, because the fundamental risk around Qantas is that the risk scope is large, difficult to identify, and difficult to observe. And some of it may or may not materialize during the course of our investment, but there are a lot of significant risk events that could turn out. But risk is important to any investment that we undertake. And again, I want to reiterate, we're going to take various degrees of fundamental risk. Some of our investments have less fundamental risk than others. Some of the unit economics around our businesses are far better than others. Some of the revenue predictability profiles are better than others. And this all forms part of our quantitative thinking around risk. We want to quantify the risk. The financial leverage in the business is a risk element input in our discount cash flows. The historical years of profitability is a risk input profile into our DCF model. The quality and depth and breadth of the management teams is a risk profile element into our discount cash flows. How many years has the company been paying dividends historically is a fundamental input in our discount cash flow. But three sort of fundamental risk pillars that we use actively in every single investment to reduce, and I underline reduce, not remove, we're only reducing part of it, is, first of all, we're never going to pay fair value for a business. Technology One is a business that was microcap at one stage, a small cap industrial business at one stage. We never owned it, and not because Technology One is not a wonderful business. It is a wonderful business. We never could buy that asset at a fundamental intrinsic value discount to where the market price was, and hence we've never owned it, right? So need to buy the asset where the intrinsic value is significantly higher, because that gives us a buffer in the event one of these risk eventualities materializes or crystallizes. So that's the first one. Second one is we buy businesses that either have no debt or very little debt. And if they have debt, it's typically less than 2 times operating profit. So, Ansarada had $25 million of cash sitting in its balance sheet. This new investment that we've undertaken recently in our Pure Microcap Fund, it's got no debt and it's got net tangible assets above the current market price. They're all profitable businesses, right? So if you think about it conceptually, if you're buying a profitable business that's growing or likely to grow in terms of its probability set, it's got very little debt or no financial debt at all, i.e. it's sitting on net cash. Yes, things can still go wrong. Revenue profiles could change. Regulatory adverse event could change. New technologies could emerge that could undermine the competitiveness of their products and services. There could be regulatory change. Competitive behavior might change and become much more aggressive. All sorts of things could change, right? There's still fundamental risk out there, but you've taken huge chunks of fundamental risk out. And often, when investments that we've undertaken have gone bad, we've done badly, it's not because the business has gone into receivership or administration. It might be because the company made an acquisition after we had bought it. They levered to make that acquisition. They geared their balance sheet. And the acquisition contained risks. Those risks eventuated, and then they've got pressure on their balance sheet. They need to undertake an equity injection, dilute the existing shareholders, and all of a sudden we've got fundamental value destruction because they levered the balance sheet after we had acquired. So that's one risk element that could eventuate, right? So we try and mitigate as much of these key elements of reducing risk by making sure that the businesses that we're buying have these key metrics that we're looking for. And we also do a lot of due diligence. I mean, we've built business networks of existing executives and management teams across all sorts of sectors: telecommunications, IT, retail, professional services, where we can reach out to that network base and form and undertake product and service due diligence, so we can understand where the company's products and services sit with respect to their existing marketplace. And that also gives us an advantage in terms of assessing, professionally assessing where the company's products stand in a competitive marketplace, because there's always competition. We've never bought an asset that was a monopoly. There's always competition. How strong that competition is, how competitive their products and services are, is an important input in terms of our due diligence that we need to get across. And that's actually a question that Ryan asks. How big a factor is competition and sustainable competitive advantage in your assessment of value? And it's critical. Ryan, one of the reasons why we don't own technology to consumer businesses in general is because it's very easy to substitute for the competition, right? If you've got an Apple phone, you can substitute it for an Android. If you've got Netflix, you can switch to Apple TV or Prime. All those technology platforms are substitutable, and there's very little pain for the consumer to change. And if you're investing in, GBST, which is a financial technology platform, which provides deep key operational software for fund managers and financial services companies, and you want to pull out GBST, you're looking at a multi-year project where the chief technology officer will have career risk in that call. So if they decide to change GBST and to go to a competitor, that project ends up being a cost overrun. There's data issues, there's integration issues. There's very likely to be career risk, or at least company risk event for he or her. And so it's painful. It's much more sticky. It's mission critical. It's not, do I want it? I have to have it because it's critical to the mission. So we're assessing all of that, and we're factoring that into the risk. So this is just the return profile of our Pure again. The only thing that I just want to focus on here is the EPS forecast that we have just at the bottom of this slide. what that EPS forecast is we call out what we think the weighted earnings per share of the portfolio will deliver this financial year and the next. When we publish our September fund update, which is the month after the August reporting date, we actually put the attained EPS growth profile. And what this EPS number is, and it's a rough proxy, but it's basically the profit growth on a per share basis and on a weighted average across the fund. And another way to think of it is we think that's what the intrinsic value of the fund is going to rise over the course of 1 and 2 years. So Albert Einstein was once asked what the most powerful force in the universe is, and purportedly he answered compound interest. So if you had invested $1 million in the Pure Microcap Fund 5 years ago, today that would be worth just over $2 million. You'll be worth $2,041,000. If we continue that rate of compound annual returns, in 10 years, that $1 million would have turned into $4,170,383. If you've had invested in our deep value fund $1 million and you had maintained your investment, and that fund's been running for 14 years, it's achieved a 837.3% return, and that would be worth today $9,373,000. So the power of long-term investment with the power of compound is why I think if you're going to be investing in equities, and whether you invest in our funds or other fund managers or you have your own direct portfolio, remember, it's about investing over the long term and letting that super force of compound take effect. The reality is, if you distill all historical long-term asset classes and you rank them from return profiles and you de-lever them, so property can be tricky because return on equity, return profiles for property are levered. But if you de-levered property returns, equities would come at the top of the return profile, and that can range anywhere between 8 to 9% compound returns, inclusive of dividends per annum. That's the historical long-term return. Because we seek to, and we have historically delivered a significant outperformance on the All Ords Accumulated Index and against our respective small cap and emerging companies index. And we believe that we can attain and sustain this 15% return profile. In fact, our deep value has sustained that over the course of 14 years. And the last 1 year return is close to that 16-year return profile, notwithstanding the fact that this index our benchmark index has actually been in a 3-year bear market. And we believe that the spring is actually really loaded. So, we think, if you apply long-term investment to a high returning asset class, the best way to derive really good investment outcomes is to actually just stay the long course. You'll remove the market timing risk. You've got to be prepared to have and experience a negative base return year every once in a while. That's just the laws of averages that happen. But over the long term, you will arrive and you will derive the benefits and harvest the benefits of the return profile of this asset class and what it can deliver. Because this asset class will grow faster in terms of the fundamental growth that's engendered by these businesses. And that underpins our return profile in unison with our deep value focus. In terms of the capacity of our Pure Microcap Value Fund, it is more than half full. The glass is more than half full. We're more than halfway through filling it. I'm not going to call out, when we'll fill it. I will say that, we're over 60% full at the moment. It currently remains open to wholesale investors, but at one stage, there will come a stage where we will soft close this fund. And once we do that, I want to be clear that we won't be launching any further microcap funds. This is the only pure Australian microcap strategy that we'll manage. This fund is not a fund that can grow to $1 billion, because at $1 billion, it would actually start to hurt the investment return profiles. And we certainly don't want to do that for our fellow investors. And as the largest client in our business, we don't want to do that for ourselves either, because we're the biggest investor in this fund as well. So we're cognizant that this has a limited capacity. Now, that capacity can be fueled by way of inflows or by a revaluation event. So, if in the next 12 or 24 months, we run up a 50% return profile, we'd be very close to closing it and putting a soft close. So I do want to call out that at some stage we will soft close this fund. Got a question from Jock Carlos. Why has the deep value underperformed Pure over the last 5 years? Yeah, it's a good question, Jock. Look, there's significant crossover between the deep value fund and the Pure Microcap Fund. So the only reason for the underperformance is in those assets where they're not held by they're not cross-held by both funds, or where there's significant divergence in terms of the weighting. So, for example, last month, the Deep Value Fund outperformed the Pure Fund, I think, by about 300 or close to 300 basis points. And that was because a company by the name of Superloop, which is heavily weighted in the Deep Value Fund and only slightly weighted in the Pure, had a cheeky takeover bid by a company called Aussie Broadband, and that delivered stronger outperformance for Deep. So the only plausible reason I can provide, Jock, is that there's just been a difference in terms of the mark-to-market pricing of those assets that are not cross-held between both funds, and there is significant cross-ownership of assets between both funds, or there's a significant weighting difference. Now, there are a lot of assets as well in Deep that are fundamentally undervalued, so you should not assume that the underperformance of the Deep Fund against the Pure is sustainable over the long term. The return profile should be closer, and if you look at the 1-year return between the Pure and Deep, it is starting to close. But other than that, there really isn't a difference. I've got a question from Russell, who's asking, do I have a view on the optimum split between the MUM funds for new investors? I don't, Russell. There's 3 growth strategies in our funds and 1 income strategy, income and growth. So Global, Deep, and Pure are all capital growth strategies. They're all profitable businesses, but we don't really look at the dividend remuneration policy as a metric for investing or not investing. The high income value market cap fund pays out cashly month distributions, and in that fund we do acutely appraise the dividend remuneration policy of the industrial business we invest in. So some investors like receiving cash distributions, and the great thing about that fund is, unlike all equity income funds that I've come across in Australia, which are very good at giving you the equity income, but they're abysmal at actually giving you any capital growth. The equity income fund, which is a strategy that we've been running for over 12 years, has actually done both. We've actually provided our investors capital growth and cash distributions. We've never missed a single cash distribution. They've got a perfect track record of those monthly cash distributions. So it's done what it says on the label. Got a question from Peter. Do we pay an annual distribution in our funds? We do pay an annual distribution. In our growth strategies, being Deep Value, the Pure Microcap, and Global, those distributions are subject to a compulsory reinvestment, a compulsory DRP. The high income pays monthly cash distributions, although some investors decide to reinvest that cash distribution by way of additional units. But we do those distributions outside of the income fund are paid in July by way of a specie distribution. The income fund pays those cash distributions monthly. So fortunately, I've gone a little bit over the time that I set myself. It's had an hour, but we've gone a little bit over, but that's okay. Just before I shut the presentation, I will just keep the forum open for any last questions from the audience. Should say if you want to invest in the fund, if you want to apply, the closing date for our applications for this month is the 29th of March, and you can click on that link and it will take you to a digital application process. Got a question from Ronnie. Does Microequities Asset Management quantify target stocks, risk and volatility using traditional techniques as sharp, beta, etc.? The short answer to that, Ronnie, is we don't. And if you go back to the sort of conceptual slides at the beginning, we treat risk as fundamental risk, not price volatility, not market price volatility risks. We're not concerned about market price volatility whatsoever. We're deploying capital for the long-term 5-year plus periods. We are de facto business partners. We concern ourselves with anything that adversely affects revenue, earnings, cash flow, margins, competitive positioning, all the fundamental risks. We really don't care about share market price volatility. We take advantage of share market price volatility because that's what creates an inefficient market. The fact that we can buy an asset whose intrinsic value is significantly higher than what the market is paying for that asset. So we can buy those assets from secondary shareholders in the market, engage in the market, buy those securities when we've assessed and computed the intrinsic value to be significantly higher. But we're not concerned if we buy company XYZ and there's no change in the fundamental value and the fundamental metrics and the share price falls. That is not a risk event scenario for us. What is the minimum investment for our funds? In the Pure Microcap Fund, it's 200,000. In the Deep Value and Global and High Income, it's 100. Got a question from Michael. How much attention do you place on macro environments? So we take notice of the macro environment. Does it play a significant role? Not really. And that's because the majority of the investee companies have company-centric reasons for engendering growth that are unrelated to the prevailing macroeconomic headwind or tailwind. And that's the beauty of a lot of a lot of the investment in this asset class. We're going to get the growth independently of what happens in the macroeconomic environment. Whereas if you're Woolworths or you're the ANZ Bank, reality is Australia's unemployment rate does affect the economic enterprise of the ANZ Banking Corporation. Whereas, if we own Superloop, for example, we know that Superloop is taking significant market share of Telstra, where it's taking market share of some of its competitors. They've got innovative products that are taking market share of other vertical competitors. So our investment thesis on Superloop isn't predicated on what the unemployment rate is or what the retail environment is doing. It's company centric. We have an investment thesis on Superloop predicated in the 3 different verticals that it operates in, and we have a thesis around that. So it's one of the luxuries of investing in this asset class that you don't actually have to worry. One thing we do look at, though, and it's actually important, is what the industry vertical of the business that we're investing in is doing. We do not want to buy into an asset where the industry vertical demand is declining. It has to be in a growing industry vertical. And that intuitively makes sense, right? Because if the overall pie is growing, it's going to be much easier for a company to attain its growth because the overall pie is growing, right? There's system growth. That's the intuitive bit. The second bit, which might not be so intuitive, is when the pie ceases to grow and it starts to retract and it's declining. There's a market change in competitive behavior. It becomes vicious and much more hostile, and competitive behavior becomes much more irrational, aggressive, and assertive. And that's where you don't want to be, because typically there you go through a margin compression phase, which it means the industry is at a much more mature life cycle, and we don't want to be invested in mature industries. We want to be invested in industries where the overall revenue pie of all participants is growing, because obviously that's easier to grow your revenue if the overall pie is growing, but also, and more importantly than that, is that competitive behavior is a lot less assertive because everyone's being fed, everyone's growing, everyone's happy. So we want to be an industry where you're not the level of competition. There's competition, but it's not, it's not razor sharp competition. That's where we want to be in. So we do pay a lot of attention to system growth in the verticals that we're investing in. I've got a question from Jonathan. We understand that we should invest for a minimum of 5 years. Makes sense. But there are financial consequences if we have to withdraw money prior to the 5 years in case of emergency, death, whatever. Yes, there are. We have financial consequences if you need to redeem your units in the first 3 years. If you redeem in the first 12 months, it's a 5-year exit fee. If you redeem in the first 24 months, it drops to a 3% exit fee. And if you redeem in the first 36 months, it drops to a 2% exit fee. After the 36 months, there is no exit fee. Jonathan, I do want to reiterate, and this is counsel that I would apply whether you invest with us, another fund manager that's invested in equities, or directly. Do not deploy any type of equity capital or buy an equity security if you're not prepared. If you think that you're going to need that capital, there's a probable chance that you will need that capital within the next 5 years. Do not think of this asset class at all. You should be investing in assets where there is no market timing risk, where you can liquidate the asset it's quickly. And this is not an asset you want to be playing the roulette table in terms of market timing. You've got to be willing to deploy long-term capital. Otherwise, your investment outcome won't be driven by the underlying fundamentals of the investments you have. Hi, Carlos. There's another question from Ross. Hi, Carlos. The Pure Microcap Fund is projected EPS growth is a proxy for fund returns. It's not a proxy for fund returns. It's a proxy for fundamental returns. So let me explain. We've got our biggest single asset in the Pure Microcap Fund has been growing their earnings per share for 15% compound for the last 3 years. If you looked at its share price, it hasn't really moved. Right. So the intrinsic value is growing. Its market price is still in the doldrums, hasn't moved. Right. That's one of the assets that's sitting in that 67%, heavily undervalued and vulnerable to takeover. What we're assessing as professional investors is the fundamental value of our assets, not the market price, which is very easy to observe. We look at the share price, there it is, right? We're assessing the intrinsic value growth. So there's this significant valuation gap that's formed in our portfolio because we haven't had the repricing that's tracking with our value intrinsic growth, right? That's why this section of the pie is the biggest that it's ever been, because we haven't had the revaluation effect. And that's why we're calling it out. That's why, I'm doing this webinar to call out. This is the biggest opportunity set that I've seen outside of the two systemic shock events, because I've had earnings per share growth profile in a lot of the investee companies, but I've had no mark-to-market price significant revaluation. If you look at Superloop, which this last month became subject to a takeover bid. You pull out the income statement of Superloop over the last 3 years, and it had an incredible change in its economic fortunes. And if you look at the share price, it had actually been falling for the last 3 years, right? So this is what I'm trying to allude to. Now, what I can say is there's a Darwinian element to this. Either the market will revalue these assets or there will be merger and acquisition activity. And hence the cheeky takeover bid for Superloop by Aussie Broadband. And there will be more. If we don't get a significant revaluation in a lot of our assets, you will see further merger and acquisition activity. And when we get merger and acquisition activity, what you see is an informed buyer and an informed seller dealing at arm's length. Late last year, we had a takeover bid in the Pure, a company called Healthier. Pacific Equity Partners provided a takeover bid at an 84.6% premium to the last market price. That's Pacific Equity Partners, a hard-nosed private equity group that knows valuations. They decided to transact at a price point they deemed to be advantageous, and that was an 84.6% premium to what Healthier was being priced by the market. So that's what I'm trying to allude. Don't take it as a proxy for returns. It's a proxy for the intrinsic value growth. And that's the embedded value right now. When you buy a unit, when you pay $1.48 for the unit price of Pure, you're not getting $1.48 of value. You're getting a lot more value than what that price is, because that price is based on market prices, not based on the fair value of the assets that we're holding. So you're getting much more value for your dollar. Okay, last 10 seconds there. If any last minute questions, otherwise I think I've been very, you guys, the audience has been very generous with its time. Now an hour 30 into this. So if there's no more questions, I want to thank everybody for taking time out of their busy schedule to listen to me today. I hope you got some value out of it. Certainly in the first few slides, I think if you apply those to any of your investments and you apply them with tenacity and discipline, and you commit to them, you commit to long-term investing, you will come out with a far better investment outcome. If you don't get nervous those years that you'll get a negative-based market returns and you actually see it as potential opportunity sets, you will become a far better investor and have much more sustainable long-term investment returns. Don't think of market prices as equaling valuations. Think of equity investments as tantamount to owning a business, as if you owned it outright. Thank you. Thank you, everybody. I will now close the webinar.